Right, welcome back to the channel. Welcome back to the channel, and in this educational video, we're going to be talking about stop loss hunts. So without further ado, let's get onto the chart. I'm going to show you what they are, and then I'm going to show you some live examples and teach you how you can actually beat these stop loss hunts and avoid falling victim to them. So what we can see here is a double bottom pattern. This is a very basic retail pattern that essentially is a buying formation in the market. When traders see this and they see the market form two lows in the market at an equal level, they then look to buy the market, okay, because they see this as a support floor. Now on the flip side, double tops also exist. So a double top pattern is where we have resistance retested twice, and then generally retail traders will look to sell into the market, believing this is a good resistance. So in the case of a double bottom, what we have is people buying either from this low with their stops under the low, or maybe even at the breakout if they're looking for larger trades with their stops under the low of the double bottom, okay? But as we know, or as you'll know if you've watched my videos in the past, the markets are heavily manipulated, or not so manipulated, so to speak, but actually follow the flow of orders in the market, which actually means that it appears like the market's being manipulated when really all it is doing is following the flow of orders, okay? So if we look at this double bottom, what generally retail traders want to see is the market push up after forming that second low. However, what you'll notice, and what I'm going to show you in the markets, is oftentimes we get a move like this, where the market then drives through the lows, and then we get the real move, okay? So that is a stop and movement right there, where we essentially have buyers coming in at these lows, seeing the support floor, trusting it, putting in their orders, they go ahead and buy, stops under the low, targets wherever, they get a nice little bit of movement in their direction, and then the market comes back through, takes out their stop before continuing all the way the initial direction that the retail traders were looking for. So that is a stoppant, and that is exactly what I mean when I say stoppant. That is what I'm talking about, okay? That motion there where the market actually disrespects the lows of the market, takes out those equal lows, takes out the stop losses of the retail traders, and then begins moving in the direction. So if you are a support and resistance trader, you are going to fall victim to stoppants very, very often. Be it selling from resistance levels or buying from support levels, these stop loss hunts happen 9 times out of 10 when we get a support or resistance in the market. So what we're going to do is talk about why they happen and show you how you can avoid being beaten by them, because hopefully if you understand why they occur, you won't get caught on the wrong side of these stop hunts anymore. So here is a general layout of a stop loss hunt and what it looks like in the everyday markets. It's a very common formation, and it's one of the biggest weaknesses of retail traders for not understanding supply and demand and liquidity. So I'm going to run you through it now, show you the pitfalls, the bad places to buy, and where we want to buy, and how I'm going to show you where to buy from. So the general stoppant formation will generally start with a down move into a consolidation, or on the flip side, an up move into a consolidation, okay? But what we're going to do in this example is talk about a buying opportunity, so we're looking at this as support. So the market comes down, forms a first low, and then it begins ranging or consolidating, and it builds new lows around the same level, okay? So, they may be a little bit down like this, they may be a little bit higher, but generally we're looking at a consolidation range with one clear-cut support level underneath. So when traders begin seeing this support level hold up, they begin buying, okay? So the general idea is we may get our early buyers buying from the support as soon as they see the first reversal. We may then get confirmation buyers who believe they are buying with confirmation because they're seeing a secondary test of the support floor. We may also then get obviously buyers at the third floor, and we also then get breakout traders, okay? So when we do get that initial rally, which very often happens, we'll have traders buying into the breakout like so. So let's say all of these traders are targeting higher prices. We get an initial burst over the range, which obviously triggers the breakout trader into the position and also brings the other two traders a bit of profit. And then what will generally happen is the market will come back down, reverse, punch through that initial support floor, either taking these out at a loss or break even, and taking these out at an almost definite loss, before sweeping the stop losses of these traders and then moving to the upside. So where we're generally looking to buy from, and when we understand why the market moves how it does, we can actually successfully buy from this zone down here. So the stop loss of the majority of traders is actually where our entry point is set to be. So what I'm going to do now is take you to the live chart, show you some examples, show you why these stop ins happen and how you can actually get your entries at the same levels of the stop losses of many of the retail traders. So the example we're going to look at in today's video is GBP/JPY. This is on the 4-hour chart, and it is a great example of stop hunts in the market, how you can read them, and why they actually happen. So as we can see on GBP/JPY, we are in an uptrend. If we just quickly take a look, the structure is telling us we have higher highs, higher lows, higher high, higher low, and another higher high. Okay, so what we could expect to happen from here is the market to come down into the low that it's approaching now, form a higher low, and then begin moving back to the upside, right? So when we see this down move come to an end with this wick here showing buying pressure, and then we see another tap into this level, this is a point where many people will actually look to buy. The reason being, it looks as though we are forming a higher low. So we had the first retest, and then we've respected that exact same level again, showing us that there is a so-called support in the market. And when we see this 4-hour engulfing pattern, this would very well be a place where traders get into the market. Okay, so looking to continue the trend higher then, for example, we will just say that this is the buying point number 1, which is a very common buying point. And I know for a fact that this is a level that a lot of traders will look to get in. Support has been retested, bullish engulfing has formed, the momentum is losing out in the market, so we look like we could begin to move to the upside. Now, what the problem with this is that we are not actually following the order flow and we're not focusing on supply and demand. We're actually just looking at what we've deemed to be a horizontal level on the chart, which obviously isn't going to be the best indicator that the price is ready to move up, okay? So what we actually get then is this wick through. Now, this wick through would have stopped out those first buyers, but what this could actually do as well is go ahead and trick new buyers, okay? So when we talk about stop-ins, you'll see that there has actually been a stop-in here because we know that the retail stop losses are beneath this level and the market has come through, pierced that level, and then began moving to the upside. Now, it's not as simple as this, however. The market doesn't just run to take out stop losses, it runs for high interest zones. The reason that these stop-ins usually happen is because the accumulation, where the support floor is coming in, usually happens just above a demand zone, okay, which attracts buyers. The buyers then get into the market. We see the selling pressure dying out of the market. Buyers begin adding their orders up. The stop losses are sitting just beneath the support floor, which actually usually correlates or very near correlates with a demand zone, which is the real price area that the market's going to move into, because this is the area of institutional interest where the large players in the market want to get their large orders on, okay? So this little stop in here, what we would have to do after seeing this, I mean, this already will have attracted new buyers. But what we have to do now is work out if this is a valid stop in or if the market is likely to move even lower. So what we want to do next is identify supply and demand zones. So I have put a video out on supply and demand. You can find that over on the channel. But essentially what supply and demand is are institutional areas of interest for buying or selling. So we indicate a demand zone by marking out a zone at the bottom of a large bullish move. Now this shows us then that the area where we've marked the zone is a high interest point for buying positions, okay? This is an area where a lot of strength has come into the market, therefore an area that a lot of strength will come into the market again if retested. So if we actually mark a demand zone on here, we will see that this wick didn't quite retest that demand zone. And what we can actually go ahead and do, which I will always do, is refine the demand zone as well. So if we drop to the hourly chart, we can already see this may not be an ideal stop loss hunt. But if we draw this down to the 1 hour chart, we can see now that the refined zone, which is going to be this little consolidation area, the final candle before the real takeoff in the market, this demand zone is there. Okay, this is the real demand zone. And as you can see as well, that also pairs with the 149 key level. So now that we can see this, the stop in that we just saw doesn't seem quite as valid and quite as valuable, does it? So what we would be likely to see now is a pull down into this refined 1 hour demand zone to actually go ahead and buy from there. So rather than looking to buy yet, we would be looking for a push down into 149 and then a bullish move to the upside. So whilst retail begins to and continues to accumulate their buy orders after seeing this and believing that this is the stop point, we will be waiting patiently with our entries somewhere in this zone. We can have nice tight stop losses under the 1 hour refined zone and targets to the upside significantly, expecting that if the market does come into this zone, this is a very high interest point. We have market structure on our side, we have a little imbalance into this zone, and we also have a nice demand zone and key level crossover point. So we can expect that the liquidity runs through into this region, and while the majority of traders are now likely to get taken out of their positions once again by this downside movement in the market, we are therefore likely to get triggered into the market very precisely because we're using demand, and then we can ride the market to the upside. So as you can see, we got a small initial run as we covered before. This will, of course, attract those buyers more so, and even now account for the breakout traders who are looking for a breakout of these previous highs. So we have both the buyers from the bottom of the range and also the breakout traders who have now been taken out of the market on the run down into this real demand zone where we can actually then catch our reversal. So if we just neaten this up a little bit, we can see that the demand zone we focused on, that 1 hour refined demand zone with a very tight stop loss underneath, was tapped into perfectly, and then the market began moving to the upside. And if we just allow the market to play out, it will be a bit slow because this is how the market moves, but it does move all the way up over those highs and through the target. So as you can see, rather than getting caught up on stop hunts and actually losing to stop hunts, you can learn to catch the bottom of these stop hunt movements as your trade entries. Now, what you can take from this and what you can learn from this video is to not follow the retail accumulation. When you see equal lows forming in a market and you think, okay, a support floor is forming, it's time to buy, it's dead wrong. You don't want to buy from equal lows. You don't want to buy from an equal support. What you want to do is find the demand zone in the market and actually buy from that point, because that's the point that the market is very, very likely to drive through into to take out the retail buyers before giving you a very profitable, very beneficial condition. So I hope you've enjoyed this video. I hope you found some pointers. Thank you for watching today's video. I hope you found a lot of value. If you want to get serious with trading, head over to the link in the description and join my course and community. There you'll get access to my full trading strategy, 10 plus hours of educational content, along with my trading community, where I send out daily analysis and alerts, as well as case studies and additional educational content. Included is also the members area, where there are 40 plus additional educational videos, and I post new market breakdowns there every single week. If you want to join, you can head over to the link in the description and either join my standard course package, where you get access to everything we've just spoken about, or the deluxe package, where you get to sit down for 3 personal hours of one-to-one guidance with me as well. So thank you for watching, and I'll see you in the next video.